Welcome back, everyone. It's June 4th, 2020. I'm Jerry Hall, and here's the view from Costa Rica. A quick peek at the market shows us that, we're kind of right where we were. Not a whole lot's going on. However, there is a whole lot going on. Today's video is make millions on crypto. So as an investor, we have one job, get a return on our investment. And there are two ways in which this can occur. One, that the asset we've invested in appreciates. That's the value rises. The second is interest and or dividends. This is a yield that is returned for the investment to the investor. Now, history has shown us that it is not the norm to find assets that embody both capital appreciation and pay interest or a dividend returning a yield. Here's some traditional assets. You got personal real estate capital appreciation only, bonds pay an interest or a dividend, i.e. returning a yield, but the actual underlying value is just returned to you. So a $100 bond will pay you X percent, whatever the interest on that bond is, will pay you over that period of time. But when the bond comes to maturity, you get $100. Well, if there's a lot of inflation and things of that nature, the $100 is now only worth 80. Anyway, long story short, we'll keep going. Gold and precious metals are strictly a capital appreciation play. Now, investment real estate, obviously capital appreciation with hopefully a return on your investment, some yield as it pertains to rents and things of that nature. But it's a tricky game. There's always overhead and there's always things. Some people do investment real estate very well. Some people fail miserably. Now, in the stock market, every single stock has a capital appreciation element from an investor standpoint. And some even pay dividends, which is wonderful. Funds. This is the tricky one. Mutual funds, 401k retirement plans. These are all investments that have a capital appreciation element to them with an interest or dividend that's usually reinvested. But keep in mind, 401ks and mutual funds and other vehicles like this have a lot of tricky fees involved. You should be very aware of the fees the management is charging to manage that fund or that 401k. If you haven't investigated yours, you should. You may find that you are a better manager of your money than they are. Now, recently in the investment world, crypto and digital assets have come into play. And for many of us, almost all of us, I would venture to say, it's been strictly a capital appreciation investment. In other words, I buy Bitcoin, Ethereum, or XRP today at this price, hoping that in a future date, it's going to rise in value. I'm going to be able to sell it, and I will have made a return on my investment. Obviously, less capital gains taxes, etc. Now, soon, some of these proof of stake networks and platforms, protocols, what have you, are going to be offering a return to token holders who pledge their tokens to validating pools. This removes mining from the validation, authentication, transaction verification process, rewarding token holders. This is a very fascinating concept, one that we're going to dive into a little deeper. But keep in mind, before I move on, it's always important to analyze your risk. Every investment has risks, some higher, some lower, and the stated projected return is determined by the asset's associated risk factors. It's always very, very important to analyze the risks associated with any of your investments. So please do your own research. And remember, not your keys, not your crypto. So if you pledge your tokens to an exchange and that exchange goes down, well, there it is there. these new, soon to be on the board protocols like Ether 2.0 and the Cardano Shelley are protocols that will allow you to stake from your wallet. That's pretty darn safe. Let's go take a look at the ETH 2.0 and the Shelley Cardano reward calculators. And we're even going to play around with a little compounding. Here's the Ethereum 2.0. Now, keep in mind, it's got a pre-programmed in here, it's got a 365-day period of time. And it's saying to the right of the screen there, you say that it would literally cost you, if you started today, $7,775 because you need a minimum of 32 Ethereum in your wallet to stake it. And if you compound those rewards over a year, in other words, you don't take the rewards as they're distributed in the form of Ethereum, you let them sit in there and compound over that 1 year, your reward value will be $938.78. Now, let's say I want to take those returns as they're issued. At the end of the year, I still have a return value of $893. That extra $100 was from the power of compounding, and it was just over 12 months. Now, what's really fascinating here is that the total rewards rate, this 11.49% yield, is so incredible in that the tokens that I'm staking are in my wallet. I have control over those tokens. And to get 11.49%, you can't get 11.49% on the most pristine bond on the planet, which is the US Treasury bond or a T-bill. We're in a low interest rate environment, folks, and these kind of returns that you're seeing from these Ethereums, and we'll take you over to Cardano here in a second, are absolutely phenomenal. Not to mention, because you've stayed in crypto, all of the capital gains issues don't come into play unless you actually come out of the investment into some other crypto or into fiat. Let's go take a look at Cardano. Here is the Shelley Incentivized Testnet calculator. Now, this is the simple version. I didn't press the advanced options. Links to all of these things will be in the description. I encourage you to go play with them. But what I did is I started to mess around. I do have some Cardano, and I have a long-term vision of an investment plan for my 10-year-old daughter. So I'm going to start with 22,000 ADA. Now it shows me a daily, a monthly, and a yearly return of tokens. So 6 tokens a day, 185 tokens a month, 2,256 tokens a year. And there's an associated percentage of yield, right? Now, all this is incredible, but it's only looking at a year. My daughter's 10. This is where this incredible magic of compounding interest comes into play. This is how the wealthy get wealthier, is compounding interest. Warren Buffett, one of the most successful investors in the planet, using a very simple formula of only investing in companies that pay him a dividend to hold them, and then analyzing that company to see if it has long-term value. Can it stay in business? Can it continue to produce a return, etc.? Berkshire Hathaway has just been incredible in generating returns because he uses a very simple formula. I want to buy a company that I am darn certain it's going to increase in value as a company, but will also pay me regularly a dividend and a nice dividend to hold it. And then I will just allow compounding interest to go to work and do what it does. So as it pertains directly to my daughter, as you can see here, right here, starting with 22,000 Cardano, adding 185 Cardano a month, that 10.254737 annual interest rate over 25 years would produce 541,714.91 Cardano. Now keep in mind, Cardano is 8 cents today. If Cardano is successful, it will appreciate in value. Each ADA will appreciate in value. So let's just use some round numbers real quick. Let's say that Cardano at the end of this 25 years is worth $1 for each ADA token. Well, what are we talking about? At 8 cents, I didn't buy my Cardano at 8 cents, but just say at today's rate, the 22,000, I would need what, $1,750 to start this? Rough. I just did a quick calculation. You can do the math at home. So for 1,750 bucks initial investment, after 25 years, it would be worth $541,714. That is just incredible. Again, the point wasn't the exact numbers as it pertains to my daughter's future capital. It's for you to see these tools and start to use them for yourself. The links for these calculators will be in the description. Play around with the numbers. Have some fun with this stuff, folks. Now, since today is Thursday, we're going to do a little theoretical Thursday because I've covered Ether with the calculator, showed you the ADA calculator, showed you a compounding interest calculator. Here's a concept that just came up, right? Well, it's actually been a concept that's been floated around and debated for a long time, and that is this X-pool concept. We know at one time Ripple trademarked the term X-pool, and then I think the trademark fell off. But the point is, I'm going to speculate here. I'm going to draw a picture for you. Check this out. So there is, let's say there is an X-pool, this new loan program that Ripple's hiring for, this thing that Miguel Valles and Brian Madigan have probably been working on for the last 2 or 3 years. Let's say it looks something like this. Ripple and PolySign facilitate an open participation vehicle where any wallet that's KYC'd, AML, CTF'd, etc., can pledge XRP to the X-pool with a return schedule based on the amount of XRP and the length of time pledged. Now, this X-pool would then be used to make XRP available to any RippleNet partner, whether it be a bank, an FI, or an exchange, just the way the Federal Reserve issues special lending vehicles to prime brokers and other central banks. This is a playbook that everybody in the financial services industry understands. They speak this language. This is not a new concept. It's only the underlying asset that's changed. So instead of the US dollar, it's XRP. Here's an example of how I think something like this could work and benefit the industry. Bank of America puts up $2 billion in pristine capital, something like treasury bills, to have access to $2 billion of XRP for 24 hours, 48 hours, 72 hours, etc. It could be 14 days, 21 days. Length of time isn't important. Just knowing that the longer the time period, the more expensive it is to borrow, or the higher fees associated with borrowing the XRP. Okay, let's move on. Bank of America would draw off that balance with each transaction and return the XRP or the equivalent dollar value within the terms of their agreement, 24 hour, 48, 72, etc. Never having to actually hold or purchase the XRP. No risk. or minimized risk. I think there's something to this. It makes sense. It plays within the rules of the existing game that they're all playing by already. The only thing that changes is the underlying asset. And we all know how valuable this technology is to the financial services industry, whether it be banking, whether it be corporates that move money with payroll and vendor supply chain payments. I mean, it's all right there for us. I want to give a special shout out to Crypto and Coffee. The link to that YouTube channel will also be in the description. Nick Black is a guy I met when I was collaborating with the On the Chain channel. He's launched his own channel. I contribute with him all the time. He does a daily live stream at 11 a.m. Pacific Standard Time. That's 2 p.m. Eastern Standard Time, Monday through Friday. Various guests come on. It is a very macroeconomic view at crypto specifically, but also greater markets. This has been a place where my financial literacy IQ has gained. It has gone up. There's been capital appreciation to my financial IQ. And for that, I am grateful. I want to encourage each and every one of you, if you have time, to come and join and participate in that live stream if you want. If you don't, that's cool too. But I want you to know that it's there. These are exciting times, folks. I hope this video brought some value. I do appreciate all the new subscribers, all the folks that leave comments. I encourage your comments, whether they're contrary to my view, support my view, or just present your own view. The engagement that I've received over the last 6-7 days has just been phenomenal. And I want you all to know that I'm extremely grateful for your participation in the growth of this channel. If you haven't subscribed and you found some value from this, please subscribe, hit the notification bell. Please hit that like button. Leave a comment. We're all in this together. Happy hunting, everybody. And from Costa Rica, Pura Vida.